talk about homework 10 and homework 11, which will be due Monday. So we'll be covering that in class, but just a couple of logistics items in terms of what's coming up. So Friday, group case 3 is due. Anybody have any questions on group case 3? Yes.
Do you have to do all 6 worksheets?
Yes. Okay. And get all the math right and answer all the questions in the write-up. Yes. Other questions about group case 3? So group case 3, Friday, 5 p.m. Make sure somebody in your team submits on behalf of your team by that time. Okay. Now, Monday, 10 a.m., homework 11, final homework assignment of the semester, which we're going to talk about during individual assignment during class today. So make sure you get that done. And a week and a half from now, your group projects are due. So you picked an industry. You're going to have to make sure that you turn in that group project by Monday, May 6th. And then either Monday or Wednesday, you'll be here both days. You'll be presenting for a big chunk of your semester grade as well, the PowerPoint, and turning in the papers. So that's also coming due. We'll talk more about that next week. But the short answer is you got to do an EIC on the companies. You got to do a historical analysis, CFI ROIC tree. You got to do a multiples analysis on that company plus 5 peers, 6 total companies. And you're going to do the valuation, as is bull bear target, and sanity check, which is part of homework 11 that we're going to talk about today. Okay, so that's all coming up as we get near the end of the semester. Again, in the assignments tab, the other thing I will mention is that the final exam opt-out is also going to be evaluated that week as to whether or not you can opt out of the final exam. If you had a problem, remember that in the extra credit, there'll be an assignment replacement, which you can take to replace one of your individual homework assignments, not an exam, but it will replace your lowest one with a full score. Yes?
Sorry, what week will that be evaluated? Like the week of May?
So you'll know the week of May 6th whether or not you have to take the final exam. But the short answer is if you could miss up to one assignment and then do the assignment forgiveness to replace it. But if you miss an assignment or get a 0 or less than 50% on any individual homework assignment, you have to take the final exam. So, yes?
Did you have to do the first extra credit to get
No, extra credits don't count. And that's the final thing, which is next week, I will also probably give a final extra credit. So for those of you in search of points, you'll have one last opportunity next week to do an extra credit to get some points. Okay? And so again, remember, there's probably going to be 3 points next week, which means there'll be 105 total points for the semester. You'll need 93 of them to get an A, 90 of them to get an A minus. Okay? All right. So today, as I said, I want to talk a little bit more about homework 10 because there's one thing that we didn't get a chance to cover in Monday's class. So it's going back. The summary for Monday is what made this multiple analysis more difficult is for this industry, the past or the current position in the next couple of years do not represent the long-term future. Therefore, the multiples represent a far different perpetuity than what the next couple of years represent, so we had to adjust. So what it meant for Nokia and Ericsson is that the only way that we represent the current multiples of the companies is the market's projecting some form of positive spread, so we had to make the spread positive. By doing an as-is valuation, we knew for Nokia it was somewhere in the mid-30s for an operating ROIC, and for MSI and Ubiquiti, the 2 companies I had done, they were somewhere in the 70s. Ericsson, we put somewhere between, but one of the challenges in putting Ericsson somewhere between at about a 40% ROIC by proxy is we got a G of 8%. Okay, so this is the other part of the solution, which we did not talk about on Monday. This does not make sense. Ericsson having a G of 8% into perpetuity and Ericsson having a 40% ROIC into perpetuity just doesn't make sense. So to get an actual solution for homework 10, we have to make another further adjustment. So what is that further adjustment? So heretofore, I have told you that multiples are an expression of future growth and spread, right? Based on the spread, any positive spread, we got to get crazy growth. And that doesn't make sense. And the reason why is because we had to raise the ROIC. And what we've left constant this semester is WACC. Here's an example where we have to change the WACC. Okay, so basically, just like we've now run into a circumstance where we had to flip the spread, sometimes you have to change the WACC. And how we change the WACC and why we change the WACC, I need you to understand how Bloomberg calculates WACC to understand why we need to change the WACC. So let's go to Bloomberg. All right, I'm going to go to Ericsson because that's the company that we're having more trouble with. So here's Ericsson out of Stockholm. The reason why I know we're going to have to change the WACC is, and the G is a problem, is because if you go to EEO and you look at, and I don't handle SEC very well, so I'm going to switch this to US dollars. Basically, Ericsson's not growing. Last year, 24 billion in sales. 2022, 24 billion in sales. Over a 4 or 5 year period, flat. Okay, so that's the problem with the 8% G. Like, they're really not growing their earnings and cash flows all that much in the next few years. So growing 8% to perpetuity for a 23, 20, or $25 billion company, 24 billion euro company, just doesn't make sense, right? So that's the problem with the G that we have. So let's go back to the WACC. So why do I think that the WACC is a problem? Well, here's the first part. These two companies have WACCs far lower than Ericsson and Nokia. And by the way, Ubiquiti is an early stage growth company. Well, that early stage growth company has a much lower WACC than Nokia and Ericsson, which are 25 billion euro established companies. So I'm just saying, if you just look at kind of prima facie, something looks amiss here, right? So let me go forward. So let's talk about how Bloomberg calculates WACC, WACC. Where could this issue come from? Well, if you go to the WACC screen, in the upper left-hand corner, here's WACC. It's just a weighted average between the debt and the equity. Well, that looks pretty normal, right? Weighted average debt and the equity looks normal. They calculate a cost of debt, 0.3%. I don't think 0.3%, 30 basis points for their debt, is what's causing their WACC to be really high. And if you want transparency at Bloomberg, you can click on something and it'll tell you how they calculate their cost of debt. And what they're doing is they're basically using the yield to maturity on the debt and a tax rate. And the point is, I'm not too worried that the debt is unreasonable. It's this 14.4% cost of equity that seems a little high. Why? Transparency. Bloomberg is using CAPM to do cost of equity. They're using 40 basis points for the risk-free rate. Now, RF, risk-free, plus RM minus RF times beta is CAPM. That's what you see on the screen. The risk-free rate they're using is 40 basis points. The problem is they're actually using the Stockholm Swedish risk-free rate because Bloomberg uses the risk-free rate on the country that it is based on. And that could be part of the problem. Because if we were doing a US company, we would use the 10-year treasury. Bloomberg would use that. If they're using a EU company, they're doing it based on the company's host country, which is Sweden. And even in Sweden, 40 basis points doesn't seem to be that high for a risk-free rate. But actually, it's not the risk-free rate we want to use because Sweden is not risk-free. Which country in Europe is risk-free that we should really use if we're doing an EU company? Who's the only country in Europe that's truly risk-free? Germany. Matter of fact, think of it this way. The EU is Germany. All right? Germany won the economic war after World War II. They now dominate economically the EU. They have the best economy, the strongest balance sheet of all the countries in Europe. It's not France, it's not Italy, it's not Spain, it's Germany. And so therefore, German bonds are really what the risk-free rate is traded on in Europe. So even if I were doing a French company and I was looking at risk-free rates, I'd use the German bond, not the French bond, for risk-free rates in Germany. So that's the point. When you get to other parts of the world, you can get really weird risk-free rates because you're using the country risk-free rate, you're not using a true risk-free rate. All right, so again, it gets really questionable when you get to Asia. Because, for example, do we consider China to be AAA? Okay, and right now, the credit markets don't, but they're the closest probably to AAA of the countries out there outside of Japan. So essentially, long story short, you got to figure out what your risk-free rate is. That's why people like the U.S. Nothing else. At least we're easy, and we're the benchmark that everybody else sets. So problem is we're now dealing in euros. We go with the currency for euros, risk-free in euro would be the German bond. But here's the point. 40 basis points doesn't look crazy. So I don't think I'm that far from the German bond, and that's not why the cost of equity is so high. Beta. The beta of Ericsson is 1.16. That's also not crazy. Given everything we talked about in our last class, there's some cyclicality in this business. There's some uncertainty about their business cycles. So I would expect a beta above 1, and that doesn't hurt the cost of equity all that much either. Here's the real problem. The risk premium. The risk premium right now is 12%. That's the problem. Is that the RM minus RF for a $25 billion company is 12%. Now, in the US, according to the Chicago data and the Booth School, that the long-term risk premium in the S&P 500 is between 5 and 7%. It's averaged about 6. All right, this is what's called a Stocks 600 company, which basically means it's the equivalent of our S&P 500, and the risk premium right now in Europe is double what it is historically in the US. That's very high, right? So it's important to understand how the academics have come up with the risk premium and how Bloomberg calculates risk premium to understand the pros and cons of using Bloomberg. So again, in the beginning of the semester, we did US companies. I did that intentionally. One of the reasons I did that intentionally is because the US is not as screwed up as Europe right now, as much as we like to think we are. So here's the point. How does Bloomberg calculate risk premiums? What Bloomberg does is I'll start with the S&P 500, SPX. And then I'll go to EEO. This is the earnings estimates on the S&P 500 index. Because you add up all 500 companies and you got the earnings estimate for the S&P 500 index. It's also a PE on the S&P 500 index. So they know the earnings and they know the PE that the earnings will eventually lead to. What Bloomberg does is it backs into a discount rate that makes the two equal. So when we're doing a valuation in our model, we're forecasting a cash flow, we use a discount rate to get a price. What Bloomberg does is it says, I know the price, I know the earnings, solve for the discount rate. So Bloomberg creates a cost of capital, but cost of equity in this case, by working backwards. It knows the risk-free rate, it knows the beta, it solves for the RM minus RF. So the risk premium, Bloomberg backs into based on current market prices. So here's the thing. If I look at, and I'll use Procter & Gamble as an example, US company, and I go to WACC, and I go to CAPM, right now in the US, it's using a little under 7%. Well, that doesn't seem crazy to me, right? Because it's basically saying, take the expected market return, this is the discount rate that makes the price and the earnings equal, subtract out your risk-free rate, adjust for your beta, and you basically get an equity risk premium of about 7%, and then with beta adjusted for Procter & Gamble down to 5% because their beta is 0.72 of the market. But 5 to 7 is but what the S&P 500 RM minus RF have been bouncing around between historically with Chicago. So today, being close to 7% doesn't seem that crazy. But what's happening is Europe is not within that 5 to 7% risk premium for big companies right now. Bloomberg is showing it to us that Europe is being discounted at a much greater rate. Hence, that's the problem. Okay. So what I'm telling you is, I don't know whether it's Brexit. I don't know whether it's the weak economies of Portugal, Spain, Italy, whatever. I don't know if it's the political uncertainty. All I know is people are attributing a lot more risk to Europe right now, and they're discounting Europe at a much higher rate. And I think Nokia and Ericsson are being hurt by that, not because of the markets that they're in, but because of the countries that they're in as their home country. And so Bloomberg is having trouble with this because using its algorithm, In normal times, it works great. But this is not a normal time for Europe, and therefore, it's telling us that these companies are being hurt because of extra high discounting, that the market prices are probably lower than they should have been, assuming long-term premiums, but hence, it screws up our academic formulas when we try to back into this stuff. So when I was doing this early in the semester with you, with US companies, I didn't have to worry about it because I looked at the risk premiums and I saw that the US risk premium looked normal. So I knew when you backed out the cost of capital against normal risk premiums that you were going to get reasonable results. The problem with these European companies is that's not the case. And then we're getting screwy results. So how do we put in a more realistic premium? Because what I think is actually happening is the buy-siders that own these companies are saying, I'm not going to use the risk premium for 2019. I'm going to substitute my own long-term risk premium for these companies, and that's the way I'm going to price these companies. In fact, you could argue that if I follow that logic, Nokia and Ericsson are undervalued because right now they're being penalized by uncertainty in Europe that if it gets resolved will lead to an upside in their share price. Okay? And I think that's actually why the PEs and EV to multiples are higher. Right? So how do I come up with a more realistic multiple? I'm going to give you a simple proxy. There's many ways to do this, but for simplicity, here's one way to think about this. Let's go back to Ericsson. So I'm back at Ericsson. I'm going to go to RV. Or try to go to RV. Go to custom. And I'm just going to look at our spread template because on our spread template, we have our WACC. So this is global. These are Ericsson's global peers, and the global WACC is 9.5%. Matter of fact, if I switch this to a US WACC or North American WACC for the industry is 8.7 versus if I go to Western Europe, it is 10.3. So that's what I'm saying. This is the country premium. You can see clearly just across the companies in this industry, as you switch to the different parts of the world, that the risk premiums are starting to change. And I'm telling you that I don't think that Sweden is some crazy risky country. I don't think that Finland is some crazy risky country. So I think that, as I said, this high risk premium for these two companies is much higher than it probably should be. So let's go back. One way to do this is, and this is by proxy, let's assume that the risk of these companies is not all that different. So we're going to use the industry WACC rather than the individual company WACC to represent them long term. And so I'm going to use 9.5%. I'm not going to use 12 or 13%. Now, a better way of doing this is talk about equity betas and asset betas, because the CAPM is based on equity betas, right? And if you unlever an equity beta, you get an asset beta, and theoretically, all these companies should have pretty much the same asset beta if they do the same thing. So the primary difference should be capital structure. And oh, by the way, Nokia and Ericsson have almost no debt, so it's not like there's a lot of bankruptcy risks associated with these two companies. So theoretically, that, if I wanted to take some time and do this, I could probably better proxy it out by getting an asset beta for the industry, levering back up based on their capital structure to get an equity beta. But I don't have that time, so what I'm just going to do is say approximately industry average. Okay, so they have an industry average cost of capital, industry average capital structure. It's not too far off, probably in that range. But notice what happens to our multiple analysis when I make this 9.5. Now, I don't have to have the G's that I did before, which look much more reasonable. That's the other half of the solution. Is that we didn't have to do this for US companies because the US companies were normal. We did have to do this for European companies because European companies right now are not normal. Option B, go to the analyst reports. We only have in this class access to JP Morgan through Bloomberg. We just don't pay for the access to other things. However, there's a data service called Mergent. It's available through the portal. Through the Mergent data service, you can get analyst reports. Okay, we subscribe to analyst reports through Mergent. Look through some of those other analyst reports. In the analyst reports, particularly take up a big firm like a Deutsche Bank or a UBS, what you'll find is you'll see the WACCs that the analysts are using. I didn't do that for Ericsson or Nokia, but I'll bet money that they're not using 12%. They're using WACCs that are closer to this, right? And that's the point. See what the analysts are using, because the analysts are not going to be using that because that's what they're advising the institutions. Because otherwise, you're not going to get these prices. Because otherwise, the data. Because think about what's happening in our model. To get to the values, we have to crank up the growth because we're discounting those cash flows so much. And so we're getting unrealistic numbers because the discount rate is too high. And so, unfortunately, this gets into what I call the art of valuation. This is why it's not just about the math. Like sometimes you have to look at what you see around you and say, this doesn't make sense. And the first clue to that would have been this screen right here. The WACCs of Motorola and Ubiquiti shouldn't be that much lower than Nokia and Ericsson, when Nokia and Ericsson are the big, stable, established players, and those are not the incumbents, and one of those is a startup. How could they be penalized so much more than these other companies? And the answer is because they're in Europe, right? And they're global companies, and they have a diverse base. Matter of fact, a lot of revenue for Nokia comes from the US. So long story short, we had to adjust the WACC. Questions about how I got there, why I got here, or how you need to think about this going here in the future. So 90% of the time, you're not going to run into this issue. Every now and then, you'll have to adjust some things. And just like I said, most of the time, leave the balance sheet as alone. Every now and then, you got to change the balance sheet. That was KFC, or was it Yum Brands? Most of the time, you don't have to change the ROIC. That was the example we ran into with Under Armour. The problem with Under Armour is that the ROIC had to change. 90% of the time, you don't have to change the WACCs. Part of the reason why I chose this is because I knew that these guys had screwed up WACCs. Not just screwed up spreads and screwed up WACCs. And we would have to adjust them. So that's actually what made this assignment a little bit more complex. But I need to show you the exceptions, if nothing else, to prove the rule. There will always be exceptions. So what I'll just say is, if you think about your industry for your group projects, how many of you are doing non-US companies in this class for your group project? What industry do you have? Anybody doing non-US? Makes it a lot easier. Because in the other sections, auto, some people are doing like German autos. They're going to run into this issue, right? They're doing tech companies. You're doing an Alibaba or somebody like that, you might run into this issue. So what I'm saying is it also shows up in your peers. So again, probably for tech companies, if your peers are international peers, you might have this type of an issue. You just got to be on the lookout. I'm not saying it's always international companies. Could be U.S. companies. We had the exact same problem with this data in the U.S. in 2009. Back we're in the middle of a financial crisis because the risk premium spiked in 2009 in the U.S. because here's the thing. In an ideal world, the way I should handle uncertainty is adjust the cash flows. That's the better approach. Change the cash flow forecast. But as a blunt instrument, the other way I can handle uncertainty, raise my hurdle rates. I think that's what's happening, is when I have uncertainty, these institutions are just raising their hurdle rates. And it's a blunt instrument. So I don't know what the cash flows are going to be, so therefore I'm not going to worry about forecasting the cash flows. I'm going to up my hurdle rate. That lowers the price. And so that makes, that kind of is a blunt instrument. It's not ideal, but it's what people do. I think that's what's happening with European companies right now. And unfortunately, it's affecting these valuations. And then what they're doing is they're going back and they're unblunting the impacts on some of their portfolio companies. And that's why they're trading what they're doing. But unfortunately, you start making all these assumptions, crazy stuff starts to happen. How does this apply to our as-is model? Well, if I use this for Nokia and for Ericsson, then in my valuation, when I did my as-is valuation, this is the solution I uploaded. Now, to help you with what I'm about to do, I posted this file to the file section of Elms. So in the file section of Elms, there is a file called Homework 10, and in Homework 10, I put in the as-is solution, which is going to do what I'm about to do, and it may be in your interest to do Homework 11, because you're going to need to do this for Homework 11, to go grab that file. Okay? So here's what we're going to have to do. What I'm going to do is I'm going to take my WACC and I'm going to make it 9.5%. So instead of doing my as-is based on the 10.9% WACC, I'm going to do it based on the 9.5% WACC. Well, that's going to change my valuation. So by doing that, what I also change in the ratios, I still had low growth, but what I also changed is my perpetuity EBITDA. This number grew to almost 19% because that's what the trading multiples suggested. But the trading multiples are distorted based on crazy risk premiums. And what I'm telling you is if you think back to the story I was telling you about the challenges this industry is having on Monday, seeing an industry, seeing their EBITDA margins go from 6 to 19 over a 5-year period of time seems hard to believe. And so that's the problem, is that that's what the as-is said, is that with little growth, their margins had to get better and better and better and better in order to justify the price. But here's the point. Notice what happens that when we lower the cost of capital, the EBITDA margins could actually fall to 15.5 or 15.6, which is about where they're going to be in 2020, and that actually matches my as-is. And to be honest with you, no growth and limited margin expansion seems a more reasonable story than no growth and dramatic continuing margin expansion year over year over year. But we had to do that in order to get our DCF to work. So that's the other nuance associated with the as-is, is I think we had to adjust our as-is. Now, we could adjust for a drop in sales, but the point is, if you actually looked at Nokia and Ericsson, they don't have a drop in sales that the analysts are forecasting. So it's really the non-continued increase in margin that's being offset by the high discount rate. And so I could leave it based on what you did prior to today's class, but I'm just saying what I've done is I've kind of created this really distorted model, which the distorted discount rate is creating a distorted future of the forecasted margins. And so even though that's what the multiples tell me, it goes back to I think the multiples are being distorted as well by the distorted discount rate. So that's the problem we're seeing in the real world. Questions? Yes, sir.
So you have your revenue growth rate at 0.
Correct. You might make that 1 or 2%. It's not going to change much. Make this 2%. 6 cents a share. The real problem when you get to close to zero growth is it's about margin. When you get to 5-10% growth, then it's the G. So with no growth, margin matters. With lots of growth, the margin matters less. The problem is these companies aren't expected to grow the next few years. And so I'm just saying I'm extrapolating that out when I did my as-is. Now, if I do a bull and a bear, I might have a different point of view. And my target could be a different point of view, but I'm just trying to do the as-is right now. Yes, sir.
You did the multiples analysis when you're updating a WACC. Was that for PE or for EV?
You got to do it for both. So the other part of the thing is I had to adopt my PE ratios. So back to, I kind of skipped over this step, but for homework 10, which I didn't do here, but basically in PE, these cost of equities also have to be adjusted. So how do I do that? Well, again, if I go to Bloomberg, add a column, WACC, cost of equity, and put in industry cost of equities as opposed to their individual cost of equity, which will also, same process, lower your G. So for Nokia, don't use, or for Ericsson, don't use a cost of equity of 14%. Use something closer to 11. Same thing for Nokia. Don't use the 12 something, use something closer to 11. And that will also give you what I think is probably more realistic Gs. So good point. I kind of skipped over that. But in the interest of time, I want to come back to our valuation. Because once I've made the changes to our valuation model, now I'm moving into homework 11 territory. So let's talk about homework 11. And I'm going to go off of this as a solution, which I had uploaded. So here's the deal. The next step is to create my bull and my bear, and then eventually my target. So I'm working through my bull and I'm making assumptions, and I start to get a share price. But how do I really know that that share price is a reasonable share price? Like I've talked myself into thinking it's reasonable, but is it reasonable? Like, is it a realistic share price that I'm going to get in the next 12 months? So I don't know. So here's what we're going to do. We're going to use the multiples as a sanity check to our valuations. We're going to triangulate, okay? Because the multiples are telling us people's view of the future across the industry. And I'm not talking about just the 3 or 4 companies in our analysis. I'm talking about the whole multiples list, okay? So I'm going to show you the solution, and I'm going to come back to the solution, and we're going to get to this file. But I'll give you an example, okay? So, because I'd done this in a previous class. But this is the template that we're about to build. And what it gets you is the multiples for the model in row 1 and the industry below. Okay? So this is the as-is share price, EV to sales, that our model creates. Creates a multiple of EV to sales of 0.63. Oh, sorry, I was playing around with it. This is my bear scenario in the last class. So my bear scenario, sorry to be confusing here. My bear scenario, you can see this over here in ratios. Doing a bear, is that basically the EBITDA margin falls to 10%. Okay? And basically G goes down dramatically to 0. Okay? So basically the world comes to an end for these guys. They crush their margins and they get no long-term growth. Okay, that's my bear scenario. All right, we'll call it the polar bear scenario. All right, so that gets me to a share price of €3 in my valuation model. So here's what I want to do. I come over here to my multiples. At a €3 share price, they would trade at 0.63 times next year's sales. At a €3 share price, they would trade at an EV to EBITDA of 4 times earnings, a 7 times EBIT, and a 13 PE. Just look at these 2 numbers. Who's trading at 4 times EBITDA in this industry? Because this is the industry, global industry that they're in right now. Who's trading at 4 times EBITDA? Anybody? Who? Okay. Does anyone know anything about ComUS? Well, they're trading at 0.75 times next year's sales in an industry that's trading at 3 times. So I'd be willing to bet they suck. My apologies to them. I don't know who you are, but you suck. All right? They're not doing well. So it makes sense that the bear scenario starts looking like they're not doing well. But here's the point. Is that realistic for Nokia in the next 12 months to be that bad? Think of this as a distribution of potential growth and spreads. And if I think about my distribution, for them in 12 months to get that bad, it's really hard to believe, given the data that I see. So I guess what I'm saying is, sanity check, this bear is too bearish. Now, I'm not saying that, and I'll mix metaphors, that today Boeing and 737 problems couldn't really hurt Boeing long term. But go back 60 days ago, could you have predicted that? Could anybody in this room realistically have predicted the problem that Boeing was having, despite all the horror that occurred? No, that was not in anybody's realistic scenario. and I'm telling you the same thing is true for most companies, is that when we do our bull and our bear, like we can't assume the world's going to come to an end because it's a 90% confidence interval. That's going to be the very, very far standard deviations from the mean. So therefore, if I think about what's likely bear, a couple, 2 to 3 standard deviations, well, that's probably not going to be there. So think about the distribution of the industry. This bear is too bearish. So I'm not saying their stock price is going to fall, but I don't think it's going to fall that much. So it just kind of helps me, this is the art of valuation, realize that my bear scenario, and I might be right in the assumptions, it's probably not going to be that bad. They're not going to get to this. Same thing. I think in my bull scenario that 5G is going to take off and these companies are going to just hit a home run. So suddenly the G goes to 5% a year, and I talk myself into growth of 6, 8, 10, and I talk myself into those 19% margins. And oh, by the way, that's a €9 share price. Bye, bye, bye. What a Backstreet Boy song. Well, now this is what I have to trade at. I'm not saying I can't get this high, but I have to double my EV to sales, and I'd have to pass a lot of companies to get there, and the ones that are that high are companies like Apple, and I'm no Apple. Okay? Or EV to EBIT of 12, and I'm at 7. So that's a big jump in EV to EBIT in the next 12 months. I'm not saying I can't hit a home run, but as I start to look at this industry, that's a big jump in this industry in a short period of time, and I'm not a startup. So again, it just helps me start to understand reasonable. I can't tell you what's exactly reasonable, but I know this isn't it. So my bull and my bear range are too high if this is the numbers. Maybe not be my story, but my numbers are too high. Because remember, we're talking about 12 by 7. Okay? So it's just a sanity check. And that's what I want us to practice to be able to do. And that is your homework assignment for Monday. So final homework, individual homework, before we get to extra credit, is you're going to do a bull, a bear, and a target for Nokia. Okay? Which means you have to have, but with sanity checks, so you explain your sanity check along the way. So you do your bull and your bear, but you got to look at the multiples that your bull and your bear infer, implied multiples, what we'll call them, and tell me that this is a reasonable bull, this is a reasonable bear. And by the way, same for your target. If your target stock price is a hold, by definition it's reasonable because it's the current price of the company. So if you tell me the current price is the future start price, people are already paying for that. I don't need a sanity check for that. But if you tell me your buy or your sell creates a different multiple, then you got to tell me why that buy or sell multiple is a multiple that I am willing to pay as an institution. So back to the target, you have to justify your target if your target is a buy or sell. So at a minimum, you got to justify your bull and your bear, but you also may have to justify your target depending on where you think Nokia would end up. Okay, and that's part of your write-up for Monday. Questions? And what you're going to have to do on your group projects as well. So the final part is, how do we get this into your model? So let me show you. You got to do two things. So first, let's go back to Bloomberg. I need to get these forward multiples. So option A is I can literally go company by company EEO screen, type the data, and create that Excel spreadsheet. And if you want to do that, you're welcome to. But I'm going to give you the easier way to do this. So we're going to go to the RV screen. And I'm going to do this off of Nokia because that's your assignment. So here's Nokia. And then go to RV. And then go to custom. And we're going to create a new template. So there are 4 multiples that we did in our multiple analysis based on forward year 2. I'm going to put those 4 multiples into this template. Okay, so I'm going to add the column. The first column is EV to sales, EV to revenue, for the second forward year. So you can type in EV and either space TO or slash for divided by sales. And you'll see that Bloomberg actually has 2 standardized fields called EV to next year sales EV to this year's sales. Forward year 1, forward year 2. Because these are pretty commonly used by the market. Bloomberg already puts those as standard fields. So EV divided by next year estimated sales. Click on this, hit enter. Right. Now, we're not going to do this, but we could have. We can also do EV divided by this year's sales. Stop. EV to sales. Don't do this. I'm just going to make a point. But I could do EV to this year's sales. So this would be, hit enter. So this would be 2019, and that would be 2020. Okay. Now we want 2020, next year's sales, so we're going to use that one. By the way, a second way to get to the same data point, don't do this unless you want to, but if you type in EV to sales, you'll see another one that says EV to best sales. Best stands for Bloomberg estimate, as in Bloomberg consensus estimate database. So you can actually tap into the EEO database. So if you go to EV to best sales, it'll say which of the best estimate sales do you want to use. A cool feature is estimate revision. So for example, if I wanted to go back to 2016 and see what the analysts in 2016 projected for 2018, I can do that. Okay? That's historical data that Bloomberg is keeping track of. That's not your assignment. Or I could go to custom period and I could look at, for example, a blended 12-month earning estimate. Or I can go to years ago forward, 2019, 2020, update, and basically create, now again, as market prices change, these numbers could change slightly, but this 1.08, 1.09, EV to next year sales, EV to next year sales. So I can create this number multiple ways. Okay, but what I'm telling you for simplicity, since Bloomberg's already done this, delete, delete, EV to next year sales. Next column, EV to or slash EBITDA. So EV to next year estimated EBITDA. That's the 2020 estimate of EBITDA. Since the top row is market cap weighted average, we got the industry average. Next, EV to EBIT. Since there's a lot of these EBIT and EBITDAs, show more matches. It'll give you a scrollable list. If you scroll down, it'll show you the search results. And we can do an EV to next year estimated EBIT. Click an update, and it'll put it in your thing. And the final one is P/E. Again, estimated PE next year. Enter. That's my template. That's my industry template. You want to save this? Yes.
Do you want some bits?
Don't want to what? Right now, you can use BICS, whole firm, global. This is global developed. You can also use global. But right now, what I really want you to do is get this template right for the start. Then hit save, or in this your icon, save as new template, and save your template as something. I called mine 443 multiples. You can call yours whatever you want.
That last column a formula?
Is it a formula?
Yeah. Oh, that's
As I said, Bloomberg has all these kind of summary saved fields. So it's using the best PE ratio. FY1, FY2. FY2.
So that's, sorry.
Can you customize it?
You don't need to customize it. Use that.
Because it says like blended current quarter, unless I'm wrong.
Hold on. Format column, edit column. Show definition. So what are you having trouble with? Where does it say it's?
Like, when I'm trying to enter it, it has options for like blended forward 12 month current quarter for semi-annual current quarter.
All right.
Don't touch it.
Should I just not touch it?
It's exactly
Oh, you're right. This one is a blended. Thank you for pointing it out. So let's not use that. Right click, delete. P/E. Let's use the best PE next year. That should be exactly that, the PE for next year. Thank you for checking that.
How do you add a column like for
Just go to the gear, add column. And then basically, once you do it, you just save your template. And to delete or change something, right click. All right, so got our template. Thank you for pointing that out. People in the video, make sure you follow along with what I just did because I'm recording this video. So here's the final step. Export to Excel this template. So this template is now in Excel. Now, a word of warning. In this lab, as part of our Bloomberg license, Bloomberg has a data cap on exporting data on each of the terminals that resets the first of every month. Bloomberg's data cap for export it's not tied to the amount of data, it's tied to the value of the data. So the lowest value data in Bloomberg is accounting data, income statement and balance sheet. You can pretty much export as much of that and they don't care. However, some data is very high value. Let's say I want to do derivative pricing or historical bond pricing or other data that is of interest to the PhD students, not you. So the problem is it doesn't take much of that to shut down a terminal's exportability for 30 days. So what we found out is that in this lab, there are at least 8 terminals that the PhD students have been using that have shut down for the rest of the month the amount of exporting data they can do. The terminals won't export until the 1st of May. And they actually shut it down about the 5th of April. So, and they're roaming every weekend from terminal to terminal. So the right-hand side of the room is where most of them are shutting down, but as soon as they shut down one computer, they go to the next, and they keep exporting until they shut that one down. So right now, about somewhere between a third and a half of the room, the PhD students have killed your ability to export until May 1st. That's the bad news. The good news is they haven't killed them all, and it does reset on May 1st. But this is unfortunately relevant to your group projects because they've apparently killed the lab downstairs as well, ability to export. How do you know that this has happened? If you go to Export to Excel and you click on Export Excel and nothing happens, that's the symptom. Because what Bloomberg has done is they've shut down the ability to export on that terminal and they won't even connect Excel to do so. That's the symptom. So if you run into that situation where you just say export Excel, export Excel, export Excel, and Bloomberg doesn't ever do anything, you got to go to another terminal because you are locked out of exporting data. Now, you can still take screenshots and you can still look at any data, but they just shut down what's called the API to the database because that's what the students are doing. They're dumping a ton of data to Excel, high-priced data, and Bloomberg just starts to shut them down. So, long story short, if anybody's running into this room right now, you export, it's like, why didn't export? That's why. Your terminals hit the data cap. Go to a different terminal. So, here's the point. This is the file. I took this file and I put it here from the last class here. Okay. The bad news is the one I put here actually had the PE that we just found was the wrong PE. So before you go take it, let me update it. Okay. It doesn't really matter for purposes of this assignment because you're going to be replacing it anyways. But here's the point. So file, save as, what am I going to call this? Downloads. Was it Nokia? Multiples. There's Nokia multiples. Replace. Okay, so you want to go grab that file if you can export. If you can export, use the file you exported. Okay, so home stretch. So go to the valuation model solution. Then have this exported file. Right click on the worksheet tab, move or copy, switch to the valuation model, scroll down, move to end, OK. What it will do is it will make that file you exported the last tab of the valuation model. It'll just insert it in there. Easier than copy and pasting a new tab. Okay, rename that tab multiples. Finally, take row 1, insert a row so that row 1 is blank. And the reason why is because when you reinsert, you won't reinsert another company, you'll copy and paste another company in here. Okay, now here's the thing. The very first row is going to be our model multiples. And as part of our model multiples, this is the EV to sales for the as is that the market is currently trading. In our model, we have an enterprise value. And we have a 2020 sales or revenue forecast. So we have EV to sales in our model. That's the good news. But here's the final piece of bad news. Bloomberg does not calculate enterprise value the same way we do in our model. This calculation and Bloomberg's calculation are different. This calculation of enterprise value is based on Modigliani-Miller. Bloomberg and the academic textbooks do it slightly differently. Go back to Bloomberg. Type in FA. And then hit enter. On the first FA screen, you will see the calculation that Bloomberg does for enterprise value. It's right here. This is how they calculate enterprise value. What do? They take total equity, the market cap. They subtract all cash, not just excess cash, but operating and excess cash. They then add in preferred and minority interest, and they add in total debt. And when you add all that up, you get enterprise value. How is that different? In our model, I'm going to call this cell E18 BEV, Bloomberg Enterprise Value. I want to calculate the same way they do. So, equals common equity plus preferred and minority interest plus interest-bearing debt. What is Bloomberg ignoring from enterprise value? Exactly. So there's one difference. They're not putting that in their definition of enterprise value. Modigliani Miller does. Minus all cash. Minus off the balance sheet 2018 operating cash minus excess cash. See, we only deal with excess cash. We leave operating cash. They don't have either one. That gets me a different enterprise value. Now, remember, I've got this kind of crazy one because remember I was playing around with the bull and the bear scenario. So let me go back to my bull and my bear. Actually, this is my as is. There we go. Make sure I was doing the right one. But here, I get a different enterprise value than Bloomberg because they have a slightly different formula. Now, let me tell you what's really different. The enterprise value doesn't include retirement-related liabilities, and when they go from enterprise value to operating value, they're just subtracting excess cash. They're ignoring the other non-operating assets. So you have to remember that these formulas were created in the 1980s. I took this class in Wharton, 87, 88, something like that. My textbook, Brealey and Myers, the first textbooks that were written, haven't changed. I think they're like the 11th edition, but they were written back in the 80s, and the formulas haven't changed since the 80s. And I would just simply say it was a simpler time. Like, we didn't have that many non-operating liabilities and non-operating assets. So when the formulas were first created, excess cash was the big one. The companies didn't have retirement-related liabilities all over the place. So it was really just debt and equity. So in a way, the formulas were simplified by the academics and picked up and standardized by Bloomberg. And nothing has changed in 40 years. So the point of the story is, like, the refinements we're making to the model here is a little bit more refined than what the academic world is doing versus what the real world is doing. But nonetheless, if I want to have an apple and an apple, I need to use the same formula that the real world is using. The other thing that they're conceptually doing is what Bloomberg calls enterprise value is closer to what we would call operating value, because it's enterprise value minus cash. They're trying to get to a free cash flow operating value. Right? We're actually separating out operating and enterprise value. But that's the difference between what you see taught elsewhere in other classes and used in the real world, is they're trying to get to a free cash flow driven operating value, which is what they're calling enterprise value. But regardless, we got to sync them up. Okay? So what does that mean? Well, for multiples, equals Bloomberg enterprise value divided by income 2020 revenue EV to sales. EV to EBITDA equals Bloomberg enterprise value divided by income 2020 EBITDA I8 equals Bloomberg enterprise value divided by EBIT, which is 2020. Operating income is what we're calling EBIT, so that's I10. And P to E equals price is common equity value. Income is income, which is net income, which is I25. PE of 20 versus 13. Now, here's the weird thing that's going on with Nokia. If you remember when we built the model, there's some things that they're putting into EBIT that we are not, because we're using operating income and EBIT. So this is when the non-operating items distort things. There's some things that are being adjusted in EPS, currency, and others that the analysts are adjusting that we left as zero and said we're not going to worry about. So we're getting a distinction because of the non-operating items and other accounting adjustments between the model PE and the real world PE. But the enterprise value isn't really different. But so again, this makes Nokia more complicated. But the point of the story is save this. Because what you're going to do with your bull and your bear is as you change your bull and your bear, row 1 will change. And what you have to write up is why those multiples are reasonable for your bull and your bear. And if your target is not a hold, why those multiples are reasonable given your target. That is your homework assignment. Now, if I were to replace this with another company, let's say this were going to be, so I'll save this, and let's say my company was Procter & Gamble, PG, then what I would do here in the RV screen custom we're at custom multiples export Excel. If this were to be Procter & Gamble, I would take all of these numbers copy, go to my model, right click, paste special values. I don't want to muck around with row 1 because that's my calculated results, but I'll adjust this by companies. So I have, now obviously I had to put the Procter & Gamble data in there, but nonetheless I'd have my Procter & Gamble multiples and then I'd have my industry. That's why I didn't want it to be on row 1. This is how you'd reuse it for other companies. Yes, sir.
So for homework 11, are we using Nokia or we're doing different?
You're doing Nokia. I'm going to make it easier for you because I need you to get to this part of the model. So what I need you to do is I need you to be able to replicate this in the model, get it to work, and then I need you to practice a bull and a bear and writing up those assumptions, but with the context of the numbers with the multiples and explaining why. Because this is not only important to the sanity check in the real world, this is part of your group project. So when your group projects are, you're doing, in your case, the healthcare companies for this section, same thing is going to apply. Like when you're doing HCA and you're doing their bull and your bear, you're going to have to make sure you talk about the multiples being reasonable in the bull scenario and the bear scenario, given the assumptions you're making. It's our sanity check. So your homework assignment for Monday is to take the as is. And I would strongly encourage you to use the as is that I uploaded as a solution. Because I put in the 9.5% WACC. All right, now if you want to, you just got to adjust your own model that you submitted to have a more realistic WACC. And I adjusted the margins given the 9.5% WACC, and I adjusted the productivity to match. Okay, so I'm just saying that it'll be easier if you start with the as is that I gave you as a solution. Because from there, you need to add this in. You need to add in the multiples template. You got to create the multiples template, add in the multiples template, and then create the Bloomberg enterprise value, create our proxy multiples of the forecast, because as you go through your bull, your bear, and your target, that's going to be part of your write-up, is to explain why those multiples are reasonable. Right? And reasonableness is in the eye of the beholder. So I'm not saying you can't have a PE out of range, but you better explain to me why. Why is it reasonable that I, as a fund that you're pitching your research to, would suddenly pay 30 times earnings when I'm currently paying 15 times earnings? At the same time, nobody in the industry is more than 20 times earnings. So if that's the case, you better really have a good explanation of why. Right? So what I'm telling you is 12 months out. What's reasonable? That's the point of these bulls and the bears. I'm not saying we don't think about best and worst case scenarios, but Armageddon isn't generally one of them every single time. Okay? That's the point of the reasonableness test. This is the art of valuation. All right? It's not the science, because the math is relatively straightforward. But these are the things that you run into at the real world that you eventually have to deal with. Okay, questions about any of this? All right, the good news, I recorded this. This will be up on YouTube. The files have been uploaded. This assignment, homework 11, due individually by Monday, 11 a.m., and I've given you a couple of helper files to help you along the way, including, if you have data problems, the export file of the multiples from Bloomberg. So what we're all using just for our solution is this data export, which was based on, I'll go back to Nokia, oh, not the US Nokia. So the export that I would want you to do would be the BICS best fit algorithm, whole firm, global developed. Just so we're all using the same one for the assignment. Okay, great. We'll talk about this on Monday. Have a good weekend.
Using the